Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we help to break down the major themes and events driving currency markets this week and in the weeks ahead. Today I'm joined by Paul Robson, who is our European head of G10 FX strategy, and we're also joined by Ian Vanderhoorn, who joins us from the US strategy team. It has been a very volatile first week in currency markets for the new year. We saw dollar strength really driving currencies to multi-month lows against the USD. And particularly in the G10, it was really sterling that kind of grabbed a lot of market attention. So Paul, I think it's probably best that we start there. There seem to be a number of cross currencies really contributing to sterling weakness. What in your mind was really the main driver?
Yeah, I think there was a lot of cross currents in sort of major markets just generally, and clearly sterling. I think for sterling, it depends on whether you look at sterling dollar or sterling euro, because I think there's different drivers, and that sort of ebbed and flowed actually over the last sort of like 6 weeks or so. So I think your first one is pricing of Trump 2.0, and that's been driving the dollar. I think there's other things around the strength of US data which have mattered. The second one is, I think, for sterling specifically, it's about stagflation risks, so weak growth, still persistent inflation. And the third driver, most clearly this week, actually, most clearly in the last couple of days, and that's the worries about fiscal policy, sustainability of fiscal policy in the UK, and how sterling is sort of seen as a sort of risk proxy, it prices in a risk premium associated with that. Maybe just a few more comments on those three drivers. So for the first one, the Trump trade, I think it's most obvious through the repricing of the Fed. The idea that inflation is going to be a little bit stickier. The Fed misses a go in January and only cuts 50 basis points this year. I think there's also an equity story there, relative growth. The US is still performing relatively well. The rest of the world is struggling, and maybe that's just a nice home for equity capital, whether for just the overall economy or whether it's chasing tech valuations. And that's pushed, I think, sterling dollar lower, over and above some of the Pacific drivers of sterling. In terms of stagflation risks, the surveys have been pointing to weakening growth. One of the stories that we've spoken about for sterling in the UK for 2024 was the economy performed relatively well, better than expected at the beginning of the year, but it lost momentum, and it feels like that loss of momentum has persisted into the early part of 2025, or is set to persist. And inflation stays a little bit sticky. Some of the survey indicators this week, just wage growth, inflation expectations, all those kind of indicators. And some, stagflation isn't great for currencies. In terms of the fiscal concerns, long end rates for sterling don't really matter until they suddenly matter. And I think that the rise in 10-year yields has got to levels where people have started to worry about sustainability of fiscal policy. But it's also been driven by higher yields everywhere. So I think the outlook would have been significantly different if global yields, for example, had been falling, but they've been rising. And sterling can be seen as a safety valve for those holding UK assets. And if I just take the example of a gilt portfolio, a sort of carefully crafted gilt portfolio, it's very hard to tweak that and get out of positions given all the different bonds. But for the currency, you can just sell the currency. And what we've observed over the last sort of 5-10 years, it's had that sensitivity. So this week, very much fiscal policy has been the driver, I think.
And I guess in terms of investor concern over, as you say, the sustainability of UK fiscal policy, are you expecting a reaction in terms of, the fiscal authorities here in the UK?
Yeah, we don't think the sell-off in sterling is enough to warrant a policy response. I think, as policymakers quite often do, I think it's going to be more words than actions. And you've already seen that. So lots of soothing words from the government, the Treasury, policymakers about fiscal rules, doing the right thing. Government departments will have to live within their means, and ultimately they will do the right thing in terms of policy. We don't think we're at a point where, for example, you'd have an emergency budget. We've got a spring statement coming in March. I mean, that doesn't feel too far in the future, but you never know. It sort of some things these catch up a little bit, and there you'd expect sort of a backloading of announcement spending cuts, things that might happen in 3, 4, 5 years, where the government would hope not to actually have to embark on them once they get to that. But the full budget won't come until the end of the year, and that might be the point where there's a bit of a reality check. We don't think there'll be any policy response from the Bank of England. They could stop QT, but it's only would have a marginal impact. We don't think the fall in sterling and inflation moving higher is enough to, for example, to see higher interest rates to support the currency. We're a long, long way from that, we think.
And where do you think now for the currency? Will fiscal policy continue to be a driver?
I think it will be a driver for the near term. At some point, the risk premium in the currency will be seen to be adequate for investors. They think that they'll be compensated for the risks. I would just caution against those who think that this is very similar to episodes in the recent past, Liz Truss government. There was specific drivers of that. That was middle of the energy crisis. There was the pension fund leverage in the system that was very specific, and then you saw a Bank of England sort of policy response there. And I think at some point, sterling's very favourable carry position will ultimately see the currency reverse. And I think on many metrics, sterling's looking a little bit cheap, as we set out in our year ahead back in November. Sterling is going to have the highest positive interest rate differential, well, I would say carry, and lots of, the way we would describe it in currency markets. And ultimately, I think that's going to be quite attractive to people once you clear out some of the positions. So because I think in bond markets, I think people have just been caught a little bit offside in this beginning of the year. And I keep reminding myself about, the first moves of January, very rarely the last directional moves you see in the month. So, I'm always saying, try not to panic, try to see it for what it is, and yields ultimately, I think, will matter for the currency.
I guess in terms of those early January moves, we've seen another move higher in the dollar. We've obviously had a lot of strength coming through in the dollar, both going into and in the aftermath of Trump's election victory. Where do you think we go from here now?
Yeah, I touched on the sort of drivers right at the beginning about the dollar and the Trump trade. And certainly for me, I mean, views differ, I have to admit, about the extent to which Trump 2.0, the trade is actually in the price. And I mentioned Fed pricing, and I think that suggests that, to a large part, it is priced or close to fully priced. And I think you're in a period of consolidation for the dollar. The dollar is expensive. It's at sort of high end of valuations. And I'm not sure that there's going to be incremental news here to drive the currency noticeably higher. For me, it's about volatility. I mean, this week, it's only the first full trading week of the year, and we've already covered Panama, Greenland, renaming the Gulf of Mexico, Canada being the 51st state. I mean, it's been quite the start to the year, and it's not doing my dry January any good whatsoever.
Well, on that note about the dollar, I do have to say, in my emerging market space, we have seen some crosses really being pushed to record lows against the USD. From our standpoint, they look, very historically cheap. So when I'm kind of looking across my Bloomberg screens, I think dollars are really stands out. It's trading at around 19 against the dollar. It hasn't been up at this level since they had a very controversial election back in May that almost resulted in kind of a vacuum in the leadership. I think it has really been kind of jumped on by kind of traders in the market as almost this proxy trade for Trump tariffs. But I think when you actually dig into the detail, it's actually a lot less exposed than you might have think. For example, it does have significant trade ties to China. China is its biggest export partner, and 98% of its exports to China are for the industrial sector. But in terms of overall exports, they only account for less than 10% of its overall exports. So you're looking at, a large, global trader that has very well diversified export markets and also key commodity exports. I'd also say the extent of the devaluation we've had so far would actually be enough to offset a 3.5% US tariff on all of South Africa's exports to the US. So I think we're actually seeing markets really kind of front run and almost act to counterbalance any potential US trade tariffs. I think, also kind of market is overlooking more idiosyncratic factors, such as the prospect of the central bank actually lowering the official inflation target, which would be much more supportive for the currency and suggest much lower easing. And I think, we have the same story kind of playing out in Brazil, where again, it's trading, within the ranges of multi-month lows against the dollar. You have a central bank that is aggressively hiking interest rates and offering investors significant carry returns in the currency. So I think those are kind of two opportunities that stand out to me. But I guess in the complete opposite vein, where we think perhaps Trump has more to be priced in, is in Canada. And that certainly the currency is not being helped by the domestic story. Ian, I have to bring you in at this point. We had the Prime Minister, Justin Trudeau, resign on Monday. Was this an expected announcement from him?
Yeah, and thank you so much for having me on the podcast today. Yeah, a lot of political changes taking place in Canada right now. But as far as it being expected, Trudeau and the Liberal Party, his Liberal Party specifically, they've been deeply unpopular in Canada for quite some time. It's really the Conservative Party, led by Pierre Poilievre. They've been really leading in the national polls and by quite an extensive amount. So Trudeau's been leading Parliament with a lack of a majority. He's been clinging on to power. He's survived already multiple no confidence votes in Parliament, and really the reason he's survived is because he's had some of the support of some of these other minority parties in Parliament. They've refused to vote with the Conservatives to oust him, in prior no confidence votes. But really, all of that changed a little less than a month ago. I'd say mid-December. Trudeau's finance minister, one of his closest political allies, Chrystia Freeland, she resigned in what appeared to be a bit of a spat with Trudeau, and particularly on how to handle Canada's fiscal situation and how to handle the incoming U.S. President Trump. So in a lot of ways, to answer your initial question, the decision wasn't really unexpected. We sort of saw the writing on the wall since mid-December. We definitely thought that we'd get a resignation before Parliament is set to meet again January 20th, and indeed we got that on Monday. I'd say that really the more important piece of this that perhaps was unexpected was that along with this resignation, Trudeau also suspended Parliament until the end of March. So this means nothing can be voted on through Parliament. And that's significant because, one, it blocks him from a no confidence vote. It sort of shields his Liberal Party for another 2 months. And that will give the Liberal Party the chance to choose a new leader and then put that new leader to the test in about 2 months' time. Although I have to say, regardless of who that leader is, first of all, I don't know who would want to step up and take that position, because regardless of who that leader is, they're likely going to face a no confidence vote in Parliament at the end of March. And we think that very likely they are not going to survive it. And indeed, the Conservative Party will probably lead a general election when that were to come. We're thinking it'll come in the spring, either April or May.
Kind of sounds like Canada's facing a long period of almost political paralysis. And I guess what is the fallout from that if you think that you've got Trump coming into power in the US and potentially looking to renegotiate trade relations with Canada?
Yeah, well, I think you definitely nailed it. That's the most important fallout in my view. I think you have two really important consequences of this move coming right now. The first is that because Parliament is suspended and they are shielded from a no confidence vote until the end of March, it will be Justin Trudeau and his cabinet who lead those initial, call it discussions or potential tariff negotiations with Trump. Trump enters on the 20th. They'll be in power till the end of March. So it will be the Liberals who lead these initial discussions. Although the second part of that, and the second most important consequence, I think, is that Trump may view this political situation, this Canadian lack of cohesiveness, as maybe a sign of weakness. He may try to use this window of opportunity, this 2-month window, to maybe be a little bit more aggressive with his demands, if you will. He also may use the window to try to enact tariffs quicker and maybe extract greater concessions in this period of in this flux period. So those are the two, I think, major consequences that we could see in the coming months, just in terms of the transition of power.
Yeah, it's not sounding good. I guess the big question from our point of view is what does all this mean for the currency?
Generally, I wouldn't say that Canadian domestic politics is the biggest driver of the currency. As a standalone on its own, Trudeau's resignation, the writing has been on the wall for some time, as I mentioned. So it wouldn't, really mark a massive shift in our view of Canadian growth or our view of the Bank of Canada or any of the longer term sort of views that we would hold. But in that vein, I guess the other drivers of CAD are really far more important, and they remain in place. This is a dovish Bank of Canada that looks set to cut policy rates again in January. You have flagging Canadian growth, and then also sort of in the background, you have what we expect to be sort of an unstable energy outlook through 2025 as supply comes online, and we're facing sort of a slower China growth story that could add pressure too. So it's not a huge driver for CAD immediately, other than the fact that it just adds yet another headwind onto the pile of headwinds that the Canadian dollar is already facing. So, like I said, you have a poor growth story, you have a dovish BOC relative to other major central banks, and you have an unstable energy situation. So add it to the pile. We think it's another headwind, and it's another reason why we're bearish the Canadian dollar. We do think that dollar CAD can continue to drift a little bit higher and potentially even test some of those 5-year highs around 145 that we got at the start of the pandemic.
Yeah, definitely. It feels like FX could be the asset class of this year. Certainly a lot of volatility, and looks like there's more to come. Well, guys, thank you both so much for joining me on today's podcast. That's about all we have time for today. Please do remember to click like and remember to subscribe so you get the latest episode first. Thanks again.